Hello and welcome to the world of bonds. Remember that a company's capital structure is a mixture of debt and equity. When we borrow large amounts of money, getting that amount of money that we need from one place can be difficult. And as a result, companies and governments turn to bonds in order to get the investing public interested in loaning them money. After bonds are issued, they're traded on stock exchanges, which makes it very easy to sell a bond and convert it to cash whenever you want to, even if the bond is not payable by the company at that point. So I can decide to lend somebody money through a bond, and then I can sell my bond at any point I want, even before the loan is due, in order to liquidate my holdings and convert it to cash. So basically that makes bonds a lot easier for a company to use if they need large amounts of money. It's no different than the example I gave in Chapter 9, where I talked about borrowing $100 from one of you or $1 from 100 of you. It may be more challenging for me to find a student that's willing to lend me $100 for a couple of reasons. One, it's a high risk that I don't pay back $100, and that may have a negative impact on your future financial position. Whereas if you lose $1, it really isn't that much of a risk. In addition, you may not have $100 to lend, but you may have $1. So it's a lot easier to get smaller amounts of money from a lender than it is a large amount of money. So what are some of the characteristics of bonds? Well, the main advantages of bonds are that shareholders maintain control because bondholders don't get a vote or any share in dividend payments. So one of the benefits of issuing any type of debt is that it doesn't liquidate or dilute the ownership of the company. So if we borrow money instead of issuing additional stock, the current owners maintain their proportional ownership, as opposed to it being spread out over more owners. A portion of the interest expense is tax deductible, which reduces the overall cost of borrowing, and the return to shareholders can be positive if the money we borrow is at a lower interest rate than the amount we generate by investing those funds. For example, I have a loan for my car and it was at a promotional rate of 0.9%. Because I believe I can invest my money at a rate earning more than 0.9%, I don't pay off my loan even though I have the cash to do so. Effectively, I'm making money by having that loan. Even if I'm earning 2%, I'm still making slightly more than 1% by keeping that loan outstanding and reinvesting my money at a higher rate of return. And businesses do the same thing. The biggest disadvantages of a bond include the risk of bankruptcy, because remember, whenever we borrow money, we're not diluting our ownership. That is, we're not spreading out ownership among new owners. However, if we don't pay back the loan, the creditor can force us into bankruptcy to recover their funds. So that's a big risk for the company that's borrowing the money. It can also have a negative impact on cash flows because, unlike equity, bonds have to be repaid at some point in the future. And in addition to that, interest needs to be paid on bonds. Whereas if we have money from owners, we don't have to pay that money back, nor do we have to pay dividends. That's not to say that one is better than the other, they're just different. Certainly from the business's perspective, debt is more risky than equity. However, one of the biggest benefits of debt is that we're not spreading out that ownership among more people. So the business has to find a balance between debt and equity financing that's going to serve its shareholders in the best possible way. Let's talk about some bond terminology. There's also going to be a bond study guide that you can find on Canvas with all of this terminology, as well as some of the most important highlights from the chapter. Bonds usually require the payment of interest and the repayment of their principal amount on maturity. The bond principal is the amount the company has to pay back to the bond holders at the maturity date. The bondholder is the person who purchases the bond. In other words, they're the person who's lending the money to the company. The amount used to compute the bond's periodic cash interest payments is also the bond principal amount, just like any other loan. The bond principal amount is known by other names such as face value, par value, and maturity value. Face value is the term we're going to use most often. All bonds have a face value, and the face value is usually 1,000, but it can be any amount. If the face value is 1,000, that's not to say that Amazon is borrowing only $1,000. They may sell thousands of $1,000 bonds, making the overall bond issuance a multi-million-dollar loan. You can see a little picture of an Amazon bond. It shows you the face value of the bond, the term of the bond, and the interest rate that the bond is going to pay. That interest rate that the bond pays is known as the coupon rate. That's the amount of interest that is paid periodically to the bondholders, aka the lenders. The bond always specifies a coupon rate and the frequency of those cash interest payments. The coupon rate is also known as the stated rate, contract rate, or nominal rate. We're going to refer to it most often as the stated rate. And the interest payments are sometimes called coupon payments. A bond's coupon rate is always stated in annual terms. So if interest is paid annually, then we know that we use that interest rate to calculate the interest payment. However, if we're calculating interest something other than annual, we need to convert the interest rate, much like we do with time value of money. So if we're dealing with annual, we use the annual interest rate that's stated. If it's semi-annual, it would be 6 out of 12 months, or 1/2. So we have to effectively cut the interest rates in half. If it's quarterly, we have to cut the interest rates by 4. For bonds, they're generally either going to pay interest annually or semi-annual most often. So that's what we'll focus on as we go through our lecture. Either a semi-annual or annual bond. If it's annual, we don't have to do anything with the interest rate or the number of periods. If it's semi-annual, we cut the interest rate in half and we double the number of periods. For example, if it's a 10-year bond, it would be 20 semi-annual periods. There's different types of bonds. This is really vocab more than anything else. It's not going to affect the way we record the bond transactions. We have unsecured bonds versus secured bonds. Unsecured bonds means that there are no specific assets pledged to guarantee repayment, so there's nothing to repossess if the company fails to pay. We could still force the company into bankruptcy and to liquidate, but we don't have any specific assets that we can seize in order to get the bond paid back. Secured bonds are bonds that have specific collateral that is pledged, meaning specific assets are pledged, and if the company doesn't make good on the bond, that we can seize those assets and sell them to get our money back. Callable bonds are bonds that the borrower, which is the bond issuer, that's the company that borrows the money, issuing the bond is effectively borrowing the money. They can call them back at any point in time and say, hey, give me that bond back, and then they can pay it off early. A convertible bond is one in which the bond holder, that's the person who's lending the money, can choose to convert the debt into equity. So rather than getting your money back for the bond, you can choose to convert that bond to equity shares. Why would a person decide to do this rather than take the cold hard cash? Well, because they think the company has long-term potential and they want to reap the benefits of that long-term potential by getting stock now and hope that the value of that stock increases into the future. A little more bond vocab. When a company decides to issue securities in bond markets, it prepares a bond indenture and a bond prospectus. The indenture is a legal document that specifies all the details of the bond offering. That document is hundreds of pages long. True story, I was auditing bonds in the real world in my old job and going through the 200-page document when I decided that I think I want to teach instead of doing this. So I was actually auditing bonds when I made the decision to work full-time at UNH. The prospectus is a regulatory document filed with the SEC. It gives all the most important details of the bond. It's really like your Cliff Notes or Spark Notes version of the bond. It covers all the highlights without all the nitty-gritty details. The prospectus also contains any covenants designed to protect bondholders, such as limitations on new debt the company might issue in the future, limitations on the payments of dividends to shareholders while the bonds are outstanding, and requirements for the company to maintain certain ratios, like a current ratio above a certain amount or a certain debt-to-equity ratio, to make sure the company maintains its solvency so it can pay back the debt when it's due. When a bond is issued to an investor, the investor receives a bond certificate. Again, when you were younger, or even maybe recently, you might have received a bond certificate from the U.S. government. Maybe somebody got you that as a gift. And that certificate is the bond. That's what you turn in to get cash. So the person who buys the bond is lending the money, and then when we turn the bond in, the company is paying back that loan. An independent party called a trustee is appointed to represent the bondholders. You can imagine if we have thousands upon thousands of bondholders, we don't want each bondholder having to keep the company in check and making sure that they're following through on all the covenants. So we have a trustee that's paid to make sure that the company follows through on all of the requirements of the bond indenture. There are bond rating agencies that assess the default risk, meaning the risk that a company will fail to pay back the bond. Obviously, the more risk associated with a company, the higher the interest rate is going to be, because in order to get a loan, if you're a risky company, the only way an investor would ever give you that money is to earn a higher interest rate. So AAA bonds are considered the lowest risk, and they would come with the lowest interest rates. And then you have junk bonds, which are the C's and the D's, and those are, and even the B's are considered a junk bond. Those are higher risk bonds that come with higher interest rates. Risk versus reward, that's what an investor has to consider when making a decision as to the type of bond that they want. The bond market determines the price of the bonds, which is the present value of the future bond payments based on the market rate of interest on the day the company issues the bonds. The relationship between the market interest rate and the bond's coupon rate determines whether a bond is issued at par, which means at its face value, or at a premium, which means more than its face value, or at a discount, which means less than its face value. So the bond contract amount is the coupon rate, also known as the stated rate. I prefer the term stated rate. So if the stated rate's 10% and the market rate's less than 10%, everybody wants the bond, right? If the bond is paying 10% and other bonds of similar risk pay less, everybody would want the bond that pays 10, which means if everybody wants what you have, you can sell the bond at a premium. I kind of think about Apple products that way. I don't know that Apple phones are really better than some of the other phones that are out there, but when we're in class and I ask how many of us have Apple products, almost everybody raises their hand. Why do we have them? Well, I don't know. Somewhere along the way, we were trained to believe they were better, and we're willing to pay a premium for those products. When everybody wants your product, you can charge more. That's the idea. If the coupon rate is the same as the market rate, then we issue the bond at face value. We're providing what everyone else is providing, so there's no discount or premium. We just get the face value. And then when the coupon rate, what the bond pays, is 10% and the market rate is greater than that, then the only way we can unload our bond is to give it at a discount. The way I look at it is this is what the bond pays. So if we pay more, we get more. That's a premium situation. If we pay less, we get less. And then I should have included in the middle here, if we pay the same, we get the same, which means face value. Sorry, I squeezed that in. But basically, all you need to know is the coupon rate and the market rate to determine whether the bond is going to be issued at a premium, par, or discount. Now, you may say, well, why do we have to deal with all this crap? Why can't they just issue the bond at the market rate? And if you remember back to the concept of the bond indenture agreement, that's endless pieces of paper that attorneys and accountants are involved in creating. Market rates change on a daily basis, so by the time we're done creating our bond indenture, the market rate's already changed. And if we go and change the rates in our indenture, by the time we're done going through and getting all the attorneys involved again, the market rate will have changed again. So in order to eliminate that issue and be able to still sell the bond, the concept of premium and discount comes in. Bond prices are reported each day in the business press based on transactions that have occurred on the bond exchange. So you can see here we have a couple of different bond issuers. Those are the companies borrowing the money and the various coupon rates and when the bond matures. And then the price. When the price is over 100, it means it's a premium. When it's less than 100, it means it's a discount. When it's 100 even, it means it's par. So what these numbers represent, it's the percent of the face value that the bond would sell for. So if it sells for 101 point something percent of face value, that additional amount is the premium. If it sells for 94% of the face value, that is a discounted bond because it's less than 100%. And it kind of makes sense if you look at these percentages. Apple and Walmart have a coupon rate that's about the same, and the market value of those are both premiums, whereas Amazon's coupon rate is significantly lower, which is why their bond is selling at a discount. So the market rate must be below 3.45 and 3.3%, which is why these two are at premiums, and above the 2.5%, which is why the Amazon bond is at a discount. The yield is effectively what the purchaser of the bond would earn if they buy the bond at the current rate and hold it until maturity. So you can see that those yields are all pretty similar. And the differences are going to be based on when the bond matures and the risk associated with the company.